Good morning. I would like to welcome you on behalf of the French, Slovak and French-Czech Chamber of Commerce. It's my pleasure to greet the members of our chambers as well as the clients of Komerční banka. Let me just quickly remind you of the rules we have during this session. First of all, please keep your microphones and webcams off during the presentations. And if you have a question or a remark, please use the chat. Now, let me introduce our today's speakers. I would like to thank our member, Komerční banka, for cooperation and the economist, Mrs. Jana Steckerová, for joining us today. And I'm also very pleased we're having with us Mr. Ján Tóth, the chairman at the Council for Budget Responsibility. Welcome, and thank you both for taking the time and for sharing your knowledge with us. And now, Mrs. Steckerová, the floor is yours.
Okay, thank you very much, and wish you good morning to everyone. So I would like to start with presentation how Komerční banka and mainly our SG colleagues see development of global economy. So let's start with our outlook for GDP growth. So there we can see our GDP forecasts for United States, China, and for the Euro area. Generally speaking, we maintain our view that GDP growth will be extraordinarily strong this year. In fact, this year global GDP growth stands a very good chance to be the strongest in at least 41 years. So GDP growth really exceptionally strong. On the graph on the bottom, you can see how close or how far we are from the pre-pandemic levels. You can see that in some countries, like in the United States, we are already at that level. But in the Euro area and in Japan, for example, and in the UK, the pre-crisis GDP levels still have yet to be regained. On the next slide, there's just a table with our forecast. You can see that for the United States, we are really optimistic. We expect GDP of 6% this year. Next year, it should be around 4%. In the Euro area, we have revised our forecast for this year to 5.1%. Next year, it should be around 4%. So it was GDP growth, and now I would like to look at the global economy in detail. I would like to start with industrial production. Industrial production or global industrial output regained their pre-pandemic level as early as November 2020, so much earlier than GDP. But what's important that since around February of this year, growth momentum in industry has close to disappeared at global level. So there's important question. What is going on and what we can expect in the industrial production field. So we believe, or the most likely explanation in our view is that the deceleration or the loss of momentum is the consequence of supply shortages. So they are, in our view, or this slowdown is, in our view, a much more likely explanation than a drop-off in demand, whether in it be consumer or for capital goods. As you can see on the graph on the left side, on the bottom, data on new orders received by manufacturing companies support this idea as well. So that's why we believe that when manufacturing, we believe that the manufacturing output across the world is likely to experience a surge in growth when production and transport bottlenecks ease. So the outlook for industrial production is positive, although of course there is a lot of risks and uncertainties. On the next slide, I just would like to demonstrate that current recession or COVID recession was extremely unusual. There is comparison of Great Recession and COVID recession. And while in normal recessions, private consumption plays a stabilizing role, this time private consumption underperformed GDP growth. So this is complete contrast to the Great Recession, but on the other hand, the drastic decline in consumption, which you can see in graphs related to GDP alone, suggests that there is still substantial potential for a rebound. On the next slide, I would like to say something about savings of household. The picture at this stage is clear. Saving rates remains well above the pre-crisis levels. And what are the reasons? In our view, those are primarily involuntary saving spikes because consumers simply couldn't spend their money due to the restrictions. So we believe that savings rates will decline, but it's the question how much and how quickly. But generally, if saving rates would return to the pre-crisis level, the boost to consumption spending would be large. But as I already mentioned, the normalization process might be long. For example, in Europe, this gap is very wide. In the United States, it's much smaller. In the United States, savings has already declined in the first quarter of this year. Saving rates was around 20%. In the second quarter, it was it was still almost 11%. So although it dropped, it's still substantially above 2019 average, when it was 7.6%. So savings of households represent a huge potential for boost to demand. But at the same time, there are several legitimate arguments as to why the accumulated excess savings may not be spent. One, and probably the most obvious, is that there is economic uncertainty, especially about job security. So consumers simply might be afraid to spend their savings. So, and another one, that there is quite a lot of evidence that the greatest part of the excess savings occurred among high or higher income households, which have lower propensity to consume. So, of course, there are a lot of questions about the further development of development of savings, but their potential to boost consumption and GDP growth is quite substantial. There are few pictures about consumption, about retail sales. You can see that consumer spending is recovering, but to very different degrees across different economies today. The United States is still well ahead. The UK is recovering strongly as well, but in the UK we have started from much lower base. On the other hand, the euro area is still lagging behind. But this is we can quite easily explain it by the fact that the UK and the United States loosened their COVID restrictions much earlier than it was in the EU countries. So that's the explanation of different development. What is a good news is that the consumption of services, which becomes possible again, is not compensated by decline of consumption of goods. So this is a good sign that consumers try to spend their savings. So now I would like to say something about inflation. Inflation data over the past 3 months have continued to surprise with unexpectedly strong readings. Of course, there are some exceptions like China or Japan, but in many countries, inflation figures surprise on the upside. So the key question, of course, is what we can expect next. And our base case remains that inflation will moderate towards the end of this year and into 2022. And the key question is whether inflation is likely to ease back to levels well below central bank's target or not. And we here would argue that it will not. So our long-term forecast for the year 2024-25 predict inflation in the United States to be around 2.2 or 2.3% or something like that, so consistent with the American Central Bank target. In the euro area, inflation, of course, will be lower, but still substantially higher than it was in the years 2014, 15, 16, when average inflation was around 0.5%. So our forecast for euro area is somewhere around 1.5 or 1.6%. Of course, there is a lot of risks and a lot of uncertainties. The risks are concentrated more on the upside than on the downside. Even though we expect current price pressures to fade over the coming months, it's true that elevated pressures on input prices ranging from commodities to transport to electronics are proving hard to contain. Indeed, some of these pressures appear to still be growing. So when you look at the first picture, that is the global composite PMI input price index, this indicator is at the highest level in 13 years. On the next slide, there are producer prices, and they are also running at rates not observed in a very long time, if at all. So unless the various upstream price pressures reverse soon, it's hard to see how they will not be passed on into consumer prices. So at this stage, the most benign realistic scenario appears to be that the various increases in costs stop, but they do not reverse in the near term, in our view. On the next slide, there is just table with our inflation forecast. This is a short-term forecast, so you can see that inflation is at elevated levels for this year, 4.3% for the United States, 3.3% next year. in the euro area, we are above 2.2% next year, but this year, sorry, but next year inflation is likely gradually decelerate, although it will remain at higher levels, as I already mentioned, than it was in the years 2014, 15, 16. So that is just our long forecast for inflation. And there I would finally look at the central bank policies, mainly on Fed and for the European Central Bank. We had a meeting of American Central Bank yesterday. The statement from the meeting reported that if economic progress continues as expected, the Fed anticipates moderation in asset purchases, which are currently running at $120 billion per month, and that the Fed is likely to end this program by the middle of the year 2022. So why it should be in the middle of the year 2022? The reason is that 9 of 18 governors see a need to hike rates already by the end of 2022. 8 governors would prefer hike in 2023 and 1 in 2024. And Fed officials have stated several times that their preference is to end asset purchases before lifting rates. So to meet that preference, the Fed wants to fuel and its asset purchases by mid-2022. And we expect the official announcement about the tapering to come on November 3rd. So it seems that tapering in the United States will be quite fast. The rationale for the rapidity of the tapering is clearly the unexpected speed of the U.S. economic recovery, which far exceeded policymakers' expectation. In addition, inflation has increased dramatically more than the Fed expected, and the speed and degree of the economic recovery reflected in governors' expectation of rate hikes. So that was the American Central Bank. The ECB is, in our view, also likely to slow asset purchases over the coming months. Although the QE policy in the euro area is more complex, that is mainly because the ECB is conducting two different asset purchase programs at the same time. One, it's this regular asset purchase program, APP, with a fixed run rate of 20 billion euros per month and no predetermined end. And the other program is the Pandemic Emergency Purchase Program, PEPP, where the volume was predetermined. It is 1.85 billion euros, which should be spent at least up to March 22. So it means that altogether the ECB is now buying about 100 billion euros per month across both programs. So we believe that the PEPP program is likely to be the first program to be closed. Most likely it will be in the spring of 2022. But given that purchases through the PEPP program are quite large, or are larger than those through the APP program, and by the closing of the PEPP program without any compensatory action seems to be too great, and that would be too big a leap. So we believe that ECB will try to smooth the process as much as possible. So we expect that it will boost, at least temporarily, the APP program. We expect that it will be from current euros 20 billion per month to euros 50 billion per month, and this step is likely to come in April. And in the third quarter, this amount will be lowered to 40 billion, and in the fourth quarter, it will be lowered to 15 billion. But generally, the aim of ECB will to make the whole process as smooth as possible. Regarding rate hikes, in advanced economies, at least, they look still a long way off. The Fed has made it clear that the conditions to start raising rates are much more stringent than to start taking QE program. So we expect the first rate hike in the United States to take place in early 2023. Then we expect a rate hike of 25 basis points to come each quarter when the Fed will discuss new prognosis. It's in June, September, and December, and we expect rate hikes to stop when the key rate will be at the level of 2.25%. In the euro area, the ECB will not start raising rates until mid 2024 in our view, and we don't expect return to positive rates until the second half of the year 2025. So that's all from my side. On the next slides, there are just table our outlook for key rates, so you can look on it just privately, and there are some summary tables. So that's all from my side, and I get back the word to Bratislava.
Thank you, Mrs. Steckerová, very much for your presentation and for your forecasts. I would like to remind all the participants that they can write their questions in the chat, and we will come back to them later. I believe we can now move on to Mr. Ján Tóth and his presentation, his forecasts. So I'm now giving the word to him.
Thank you very much for the invitation. Can everybody see the presentation?
I can see it.
Okay. I will cover the macroeconomic outlook of Slovakia that will be based on the data that was released on by the Ministry of Finance yesterday, since that's the latest forecast that we have. So I'll take the benefit from that. Then in the second part, I will probably not touch very much unless there are questions about the fiscal outlook for Slovakia, and maybe briefly I'll talk about some structural policies reforms that are being discussed in the media. So let me concentrate on the macro outlook for Slovakia. Of course, in the upcoming months, it will be all about the third corona wave. The baseline that the Ministry of Finance assumes is relatively benign third corona wave. So it means that compared to the second wave, it's more to the tune of 1/3, 1/2 in terms of the size, and it is supposed to be very quick. So it will be concentrated in the fourth quarter, and basically then it should be almost gone from macro point of view. Of course, the virus will stay with us, but it should not have a much impact on the economy into 2022. So far, they take a scenario that was published by the Health Institute, by the Ministry of Health in Slovakia. So far, the data seems to be a bit stronger than was the assumption. So we are yet to see maybe certain warnings about some uncertainty, because this is not certain that the third wave will be as benign as expected. And that is a puzzle that we see relatively large increases in hospitalization in Israel. Israel was a leader in terms of vaccination. So despite that, as you can see on the first chart, in terms of hospitalization, there is a sizable peak. I mean, smaller than it was before, but still it's maybe 1/2 of the peak, but still there is something. And even when looking at the United States, the peak is even bigger compared to the second wave. And our level of vaccinations are more comparable to some US states. And in these US states, when you look at the current hospitalizations, they are as large as we had in the second wave. So for US states that have Slovak-like vaccination levels, of course, there is a big correlation between, I mean, it's still good to be vaccinated. So there's a correlation between vaccination and this is hospitalization here. But when we take into account the lower levels of vaccinations in Slovakia, the third wave could surprise us, especially, of course, in terms of the deaths that should be concentrated for older people, but in terms of the spread and even hospitalization. So we are yet to see whether this is the case. I mean, I don't know if I should call it good news, but since this third wave is supposed to be very strong but very short, in terms of the macro impact, it should be relatively benign. So even if there is a lockdown, I mean, Ministry of Finance does not expect a lockdown in the baseline scenario. So basically, they expect that in October, early November, there will be a black. So we have, in Slovakia, we have this mechanism of traffic lights for the measures for different regions. So they expect that we will see basically black color almost everywhere. So even though it's all by the districts, by the regions, it will be widespread in terms of the numbers. But that would be limited to a relatively short time period. So let's say month, couple of weeks. And they do not expect a lockdown, so still the vaccinated people could go to shop and restaurants. So there will not be a forced closure of everything but essentials, as would be the case in terms of lockdown. So lockdown is not assumed, but even if lockdown happens, since it is hopefully to be short-lived, then basically in terms of the GDP growth, they estimate an impact of 0.3 percentage points or up to 20,000 job cuts, heavily concentrated in services. So we don't expect industry to be affected much by this intense third wave in the fourth quarter. Maybe one thing that they might underestimate is the fact that there's a risk that many schools will be closed. So there will be, parents would be forced to be stuck home with children, and that could disrupt to certain effect some jobs. So maybe there's some slight underestimation from the closed schools, but other than that, third wave is expected to be strong, but to be very short. In terms of the figures, so recovery should continue despite this new epidemic wave, but at a slower pace. So basically, the Ministry of Finance cut the GDP growth compared to the summer forecast by almost 1 percentage points. So now we see like below 4% growth in this year and slightly above 4% growth. This was more to the 5% before. So now 4% plus in 22. 23 will be a very special year in Slovakia, not just in Slovakia, but especially in Slovakia, because we will have a lot of EU funds to be implemented from this time period, as the period the program, they call it program period ends in 2023. So the Ministry of Finance expects a similar situation like it was in 2015 when these EU funds are implemented by the very end of the time period. And on top of these EU funds, normal EU funds, we will have additional recovery and reconstruction fund that will start to come by very small amounts already this year, but especially 22 and 23. So there will be a accumulation of two EU funds programs, and that will have a huge impact, especially in 23. Now, so that would be pushing the economy even to overheat in 23. But there are, of course, negatives. The one reason why the growth was cut is that we see households, as was suggested by Jana before, households also in Slovakia seems to be relatively reluctant to continue to spend extra accumulated savings in what we saw in the third quarter. So there was this expectation that since you have these huge accumulated savings, to big extent forced savings because the shops were closed. But once the restrictions are eased, and now it's people can buy a car, TV, other more expensive goods. Then the expectation was that households will spend extra, also financed by these accumulated savings. We probably did not, I mean, we don't have the final data yet, but we probably don't see that happening in the third quarter 21. So that assumption was adjusted, and of course now with the third wave coming, people could be scared to do that. So this optimistic assumption was removed. And then, of course, what we see in the industry is not affected that much in terms of demand. There seems to be a strong demand for exports. However, there is a shortage of crucial parts, and there are issues in global logistics that cause the situation that industrial companies have huge orders, but they are not able to produce what is ordered. So we have these shortages of goods, and then of course inflationary pressures coming from that situation, also coupled with the fact that the price of oil commodities is also rising. So you can, here, these are industrial orders in different countries. You can see very bullish orders these days. However, in terms of the finished products, the situation is much worse. So there is temporary there are temporary barriers to produce what is being ordered by especially these lack of parts to assemble the product. That is also the case for auto industry, which is very heavily represented in Slovakia and also in the Czech Republic. So we see this interruption of several shifts, and that should continue. By how long is the question, but there are some suggestions that this can continue to the first half of next year. So it might unfortunately be with us for a couple of more months. Now, in terms of inflation, the Ministry of Finance increased dramatically inflation forecast. So now inflation should exceed 4% in next year. So this year it will be around 2.5-ish, but then increasing to 4%, coupled by both increases in goods coming from these shortages, but also connected with the increases in the energy prices. So because of these raw commodities, oil, we will see increasing in the prices of heating, gas, and so forth for households. And that energy price increases should continue into 2023 as well, but should disappear hopefully in 2024. Now, why this is important for domestic market is that because you will see these are, so the energy prices, these are good services that you need to buy regardless of the price. So basically, if you see increases in these prices, that kills the purchasing power of your euros. Basically, this cuts into real wage growth. So despite the fact that nominal wages will be increasing by 5-6%, the real wage growth would be more benign, as people would need to pay extra for these goods and services that they need to have, especially when we talk about the energy. Now, in terms of the employment, it's interesting to see that even though on the production side we reached the pre-crisis levels already, on the employment side we are lacking by 50,000 jobs. So it seems there was a push for more productivity, and also is the fact that these services like tourism, restaurants, and so forth that have smaller productivity, that the jobs were cut, especially in those low productive sectors, services. So economy continues to produce as much as before, but with 50,000 people unemployed compared to the situation before the crisis. Now, as I suggested before, as the EU funds will start coming heavily in 22 from the new reconstruction fund, and to extremely heavily in 23, then this should push the unemployment higher, and even there might start to be problems with overheating, so the lack of people to hire and so forth. What we are seeing in Slovak figures, and which is a bit puzzling, is that we see that even industry is struggling now to hire extra workers. It's a bit puzzling because looking at US, for example, and also reading some stories in the media, it was natural to see the situation that heavily hit services like tourism would have problems to rehire people because people left jobs and they have some real world issues, like the banks are reluctant to extend mortgages to people in these heavily hit sectors. So then employers have tougher times to track them back because they're already working somewhere else and they want to have their mortgage and so forth. So that would be natural to see, but the data for Slovakia so far seems to suggest that even industry has problems to rehire people. I don't know if that's something that you see in your companies, but that would be a bit surprising. Now, the blue line is a nominal wage growth, so somewhere between 5 to 6%, and the orange line is real wage growth. So once you pay for all these higher prices, so what is the purchasing power of those wages? And as you can see, the purchasing power will be hit especially next year. So despite relatively solid wages, people, their purchasing power will not be as high as indicated by this wage growth because of this concentration of price increases next year. Later on, the situation should continue in 24. The inflation should hopefully disappear in terms of these big numbers. Now, what is crucial, as I suggested before, for Slovakia, and what is sort of kicking the economy to recover very quickly after the third wave are these EU funds. So you can see on the left side the normal EU funds that we expect, or Ministry of Finance expects, to be heavily concentrated by the end of the program period, so in 2023. The blue part are capital expenditures, investments. The rest is current expenditures. And then so that's in a million of euros. And then on the right-hand side, you can see the Recovery and Resilience Fund and how it is divided into different categories. So public investments, of course, have the biggest part. It is, in terms of the size, of course, it's smaller compared to the normal EU funds, but we did not have this before. So this is on top of the EU funds. So then you can see that 22 and 23 will be sizably larger than would have been the case without this extra recovery fund. And just for you to know, we were lucky to get from the EU, threefold the average amount of an average EU country. So in terms of the size, relatively size of the recovery fund per size of the economy, this is sizable for Slovakia. In terms of the situation in the economy, whether it overheats and you have problems to find people or not, then temporarily, at least, we should be overheating in this 2023. Next year, the economy might be close to a balance. So the recovery from the third wave should be fast. But then in 2023, you can see all these pressures to hire extra people and to produce concentrated. And on a temporary basis, because then the EU funds, that the new period starts, and usually the implementation of EU funds at the early stages of the new period is very weak. So in 24, the situation will calm down. Now, I have something about the fiscal outlook, but I expect you're not that much keen to go into much detail. So I will just summarize that because of the populistic measures in the pension system before the elections, the long-term sustainability of Slovak public finances is pretty bad in terms of the ranking among the EU countries. It's even the worst because we basically have a fixed ceiling on retirement age, and people continue to live longer and longer, so that is not financially sustainable. And also the deficits before the crisis, so still during the good times, were relatively big, while the other countries were reaching balanced budget, even surpluses. We still had deficits. And that means that on the left-hand side, these are the deficits. The black line is what was the unambitious target by the Ministry of Finance. The blue line is what we expect. As inflation will be increasing, the nominal wages, which is important for the tax intakes, then basically the new forecast should mean that the fiscal deficit will be slightly smaller, so below 3% by 2024, even with passive fiscal policy. But in terms of the public debt, that's on the right-hand side, we are now exceeding the Maastricht criterion of 60%, because there was this sizable increase in public debt. But you could see that everywhere. So the increase in the public debt or fiscal deficits were slightly below the average situation that we saw in the EU. Okay, let me skip this, and maybe the last slide is what is being discussed in terms of potential possible reforms. So there is a discussion about to modernize the debt brake because apparently it was not working as the public debt increased by all the sanction limits. However, there is some political issues by one junior coalition party that insists on the introduction of a tax break, and without that it's not willing to pass a modernization of that break, but maybe some compromise in terms of partial reform, in terms of introduction of expenditure ceilings might pass. In terms of the pension reform, unfortunately, there is little progress yet, especially if one would expect this pension reform to be passed by a constitutional act, so to be not to change every 2-3 years, and that was the ambition, but it might not happen. We'll see. In terms of the tax reform, it seems relatively unlikely that it will pass because of the communication among the coalition parties. The last thing that is being discussed in the media these days is the rental housing initiative by one coalition party. However, it is they have an ambition to start a large-scale rental housing in Slovakia. Slovakia lacks rental housing, so it makes sense to discuss how to improve the situation. However, this is a relatively very ambitious program that would build rental housing even for families with 3 to 4 1,000 euros net monthly income. So not just lower income people, but middle income. And as we expect that the construction sector would be more or less overheating because it will need to absorb all these EU funds. And already the housing market is pretty hot in Slovakia, so people can sell almost anything and the prices are rising. Then basically this concentration could push out other construction efforts by raising margins and prices. So this might be not easy to implement in an overheating construction market. That's all. Thank you very much.
Thank you, Mr. Tóth, very much for your presentation and your outlook. I hope we can now move on to the questions. And I saw a question at the beginning of your presentation from Mr. Bourgeois. Can we really compare the US population to Slovak population in terms of health and age repartition? I'm sorry, we cannot hear you. Great.
So if the question is about whether one can compare US experience in terms of the third wave or not, I mean, the hope is that it will be better than suggested by the US data. So the US data by certain US states seems to suggest that the third wave would be more painful than is assumed. So that was in the slide only given as a warning that things could be worse than expected. And especially this lesson from Israel is a bit puzzling because people are surprised to see these increases in hospitalization in Israel. So we are yet to see. These are all risks that are not included in the baseline. I mean, Israel discusses, not yet. I think it did not implement yet lockdown. So the baseline does not assume lockdown and assumes a relatively benign third wave in terms of how long it's gonna take, and that it will be sizably weaker than our second wave. But these were just warnings that there are risks to that baseline scenario.
Okay, I can see one more question from Mr. Libercan. Mr. Tóth, so how ambitious should be the consolidation in Slovakia? When should we reach balanced public finance? Is it even realistic in medium term? Thank you.
Okay, so if there's some question about the fiscal outlook. So basically, even under, I mean, if the economy develops like it is suggested, so we will have basically a very strong recovery and overheating situation in 23. On top of that, we have all these price increases that are probably unfortunately for you, but that are increasing the tax intakes because government taxes nominal incomes, not real incomes. So despite the fact that inflation cuts into your purchasing power, the government will take a tax based on your nominal income, and inflation increases the tax intakes. So basically, we had a scenario that we had below 4%, and this is all passive. So government not doing anything extra to save. So this scenario could change below 3% by 2024. Now, 3% of GDP is a level that should stabilize the public debt in terms of public debt per GDP. So the interest rates are relatively low, and it is enough to have a deficit at around just below 3% to stabilize, so that the public debt per GDP does not explode. However, from that point to balance budget would be more difficult, because we would already because then you would need to do an extra steps measures to improve the efficiency of the expenditures, or to improve the potential of the economy, because the economy, yes, it's going to grow fast by the EU funds, but just because of the EU funds. So there was some positive news in terms of new auto investments, new Volkswagen investment in Slovakia, but one should see new investments coming to the country, and that is, of course, more probable if government is improving the tax environment and so forth. So it might be relatively easy to reach a 3% of GDP deficit, but it would be tougher, much tougher to go towards balanced budget. I agree.
Thank you. If there are no more questions, I would like to thank once again both speakers for their time, and all of you for attending this webinar. I hope to see you soon on our upcoming events, and I wish you all to have a nice day. Goodbye.
Thank you. Bye-bye.
Thank you. Bye.